everybody, this is Swati Gupta, Chartered Accountant. Welcome to lecture number 10. In this lecture, we will cover ICAI question answers, practical examples and illustrations of Ind AS 7. We will thoroughly cover chapter number 2, unit number 3 of ICAI latest module. Okay, so for this, to begin with, please take out page number 2.106. Page number 2.106. We'll start with illustration number 1. Company has provided the following information regarding the various assets held by a company on 31st March 2001. Find out which of the following items will be part of cash and cash equivalent for the purpose of preparation of cash flow statement as per the guidance provided in Ind AS 7. So as per Ind AS 7, you have to check that the following items out of which is a part of CCE and which is not. Okay, as you know, cash and cash equivalent is a broader term. It includes cash as well as demand deposits and the deposits for short term which have a maturity period of up to 90 days but never includes FD, that is fixed deposits. Okay, so let's see. We'll mark over here. Later the answer part is also given. You can refer that as well. Okay, even being a professional, please watch this video because this will give you a better understanding about the Ind AS 7. Okay, while applying the Ind AS 7 on particular transactions and the amounts, okay, you will be in a better position to understand that okay, which item should be treated specifically according to Ind AS 7. Okay, firstly, fixed deposit with SBI, whatever the additional information is, but as we know, FD will never be included as part of CCE. Okay, so no part of CCE. CCE is cash and cash equivalent. In case of doubt, please ask me. Okay, don't keep your doubt as your doubt. Fixed deposit with HDFC, even its duration is shorter term. Okay, the maturity period is 30 days from the 31st March. Okay, from the end of the period. Still, we will not consider it as CCE. Redeemable preference shares in ABC Limited. Okay, let's see. Acquired on 31st January 2001 and the redemption is due on 30th April 2001. Okay, so if we talk about from 31st March, okay, at the time when you are preparing cash flow statement, you have to check that the maturity period should be less than or equal to 90 days. Okay, if it is, see here it is only 30 days. If we talk about from the year end, so it will be treated as CCE, part of cash and cash equivalent. Cash balances wherever it is, okay, inside India, outside India. Okay, if there is cash balance, it will be included in CCE. Cash balance at various branches, even international branches, it is included. Cash balances at various banks, branches of foreign banks outside India, will it be included? Bank overdraft, as you know, if normally it is financing part, but if it is an integral management part, okay, if it is an integral part of the management, okay, there are repeatedly negative and positive balances of bank overdraft. Okay, it happens regularly, then it is considered as integral part. Okay, since question has not mentioned whether such bank overdraft is integral part of the cash management or not. Okay, if such is the case, then what you will do, you can consider it either, okay, either financing or you can consider it as a part of CCE, cash and cash equivalent, but you have to make a note for the same. Okay, if you are considering that it is not integral part, you will consider it as financing. If you are considering it as part of CCE, then you have to put a note that we are assuming that the such bank overdraft given is integral part of the management. Okay, so if we consider this is temporary overdraft which is payable on demand. Okay, if you are considering it as integral, okay, if integral, then we can include in CCE portion. Now 90 days maturity treasury bills will be included. If more than 90 days, then will not be included as a part of CCE. You can cross check and understand it better with the answer portion. Okay, we'll head towards next question, illustration number 2. Illustration number 2. From the following transactions, identify which transaction will be qualified for the calculation of operating cash flow. Okay, which will be operating cash flow if company is into the business of trading mobile phones. Okay, let's see. Here the business is of trading mobile phones. Okay, they sell and purchase the mobile phones. This is their core business. So anything that is related directly to mobile phones trade will be treated as operating. Other than that will be not treated as operating. Okay. First, receipt from sale of mobile phones. Yes, operating. Purchase of mobile phones from various companies. Yes, operating. Employee expenses paid, always operating. Advertisement expenses, operating. Credit sale of cash of mobile. See, there is no cash flow. No cash flow. Okay. Neither inflow nor outflow. So this will not be considered in your cash flow. Not operating, neither. Okay. None. Miscellaneous charges received from customer for repair of mobile phones. Miscellaneous charges received from customers for repair of mobile phones. Yes, operating. Loss due to decrease in market value of the closing stock of old mobile phones. Okay. Then such loss is non-operating. Payment to suppliers of mobile phones, operating. Depreciation is non-cash. This is non-cash. Okay. Interest paid on cash credit facility of the bank. This is financing activity. Okay. Profit on sale of old computers and printers in exchange of new laptop and printer. This is investing activity. Not operating, because there is your fixed assets like this old computers, printers, new laptops, print and okay. These are your assets other than mobile phones. So whenever these are purchased or sold out, these are considered as investing activity. Advance received from customer, operating. Sales tax and excise duty paid, operating. If such taxes were directly related to any financing or investing activity, we would have treated it as financing or investing activity particularly. Okay, next. Okay, next comes is illustration number 3. From the following transaction taken from a private bank. Okay, so your core work, operating work is what? Bank. Okay, so anything that you deposit or receive, okay, interest, income and expenses will be treated as operating income and expenses. Okay, other than that, if you were any business other than banks, then such interest, dividend paid or received will be always treated as financing and investing activity. Okay, since here the core business is bank, so for such bank the interest and such all money, income, cash and cash equivalents, saving interest and all is always part of operating. Interest received on loan, operating. Interest paid on deposits, operating. Deposits accepted, operating. Loans given to customer, operating. Loans repaid by the customer, operating. Deposits repaid, operating. Commission received, operating. Lease rental paid for various branches, operating. Service tax paid, okay, always operating. Okay, furniture purchase, this is investing. This is investing, not operating. Okay, other than that, implementation of upgraded banking software, this is also investment. Investment in fixed assets. Okay, so this is investing. Purchase of shares in 100% subsidiary. See, if you are purchasing shares and it is changing, it is bringing into change in control, either you have lost control or you have gained control. If there is change in control, then this is investing activity, otherwise it is financing activity. Okay, so this is investing activity. As 100% subsidiary, for opening a branch in Abu Dhabi, your control has been changed. New car purchased from Honda dealer in exchange of old cars and remaining amount paid in cash. The remaining amount will be treated as cash inflow and outflow in the cash flow statement. Other than that, will not be included in the cash flow statement. Okay, since this Honda dealer and the car is what? Fixed asset for the business, and therefore this will be treated as investment and not operating. Provident fund paid for the employees, this is normal operating for the employees. Whatever expenses you are doing are included in the operating. Issued employee stock option, only ESOP are issued. Okay, just issued, there has been no entitlement yet. Okay, no cash has been paid, no cash settlement has been done, so there is no cash flow yet, no cash flow. No cash flow, and therefore it will not be included in the cash flow statement. Okay. Next illustration. Illustration number 4, page number 2.113. From the following transactions taken from a parent company having multiple businesses and multiple segments, identify which transaction will be classified as operating, investing and financing. We will write it over here. Issued preference shares. Okay, you are issuing shares, and in return of that, you are receiving cash. So this is financing activity. This is finance. You are issuing shares. This is always financing activity. You are issuing preference shares for sourcing. This is a source of finance for the company. Okay. Purchase the shares of 100% subsidiary company. See, since the control has been changed, then it will be investing. Since control if not changed, then it will be financing. Dividend received from shares of subsidiary. Since it is investment, the dividend hence received is also investment activity. Dividend received from other companies. Okay, you have invested and then you are receiving dividend. This is investing activity. Bonus shares issued. No cash flow. See, there is no cash flow because you have issued shares and in return you are not receiving any amount. Okay, so no cash flow. Purchased license for manufacturing of special drugs. This is type of investment. This is type of investment. Which investment? This is, for example, intangible asset. This is a type of, this license is intangible asset. If you are putting any amount in intangible asset, this will be considered under investing activity. Royalty received from the goods patented by the company. If you are receiving royalty, okay, this is also investing activity. Rent received from the let out building. Letting out is not main business. Then you have done investment and you are getting return on investment. This is return on investment. Then this is also investment activity. Interest received from loans and advances. If you were in this case bank, then this would have been your operating activity. Since here you are not a bank, then this interest received from loans and advances will be your investment activity. You have invested, you have advances, you have given some loan, and in return you are receiving any dividend, interest, royalty. This will be always termed under investing activity unless it is your main business. Dividend paid means you have issued shares. This was financing activity on which you are paying dividends. This is your financing activity. Interest paid on security deposit. Okay, this is also your financing activity. You are paying out dividend, you are paying out interest. This is your always financing activity. Purchase goodwill. Okay, this is also a type of intangible asset. This is investment activity. You are finding out any, there is any cash inflow or outflow, okay, as a source of finance, then it will be financing activity. If there is any inflow and outflow of any surplus money, then this will be termed as investing activity. Acquired the assets of a company by issue of equity shares, not parting any cash. There is no cash, then this will not be included in any cash flow statement. Interim dividends paid. Either dividends, normal annual dividends or interim. If you are paying any dividend, this is a part of financing activity always. Okay. Dissolved the 100% subsidiary and received the amount in final settlement. Since you have lost control, there has been change in control, this is always investing. Okay. Either you gain control or either you lose control. Okay. Then this is termed as investing activity. If no control change and there has been any increase or decrease in just share value or any cash inflow and outflow, then this will be termed as financing activity. Okay, are you clear? Let me know in case of doubt. Okay, if you want this PDF, okay, either you can get it from ICI portal. Okay, other than that, it is also available on the app. You can reach out from there, download it from there. Next comes this illustration number 5. an entity has entered into factoring arrangement. What is factoring arrangement? Earlier also I have told you that for collection of your debtors, you are outsourcing any agency and asking them to collect from the debtors on your behalf. Okay, entity is outsourcing such work of collection from debtors to a factoring arrangement, means hiring any agency to collect on behalf of the entity and receive money from the factor. You have received money. What happens when you are entering into factoring arrangement? Then the whole process is conducted by the that factoring agency on your behalf. And one more benefit that is included in factoring arrangement is that they provide you immediate cash. Okay, so you have received money from the factor. Examine the said transaction and state how should it be presented in the statement of cash flow. Okay, how should it be presented? As you know, there has been cash inflow or outflow. It will impact what? Cash flow statement. Now you know there is recourse factoring and non-recourse factoring. Under recourse factoring, all risk and rewards are held by the entity itself. They are not transferring risk and rewards. Since risk and rewards have not been transferred, as you know, we have discussed it earlier also, you will record the amount that have come in as your financial liability, because you still bear the risk and rewards. Okay, if there is any shortfall, you are the entity who have to bear this shortfall. Okay, if there is any surplus, you are the entity who are entitled for such surplus. If you have all the risk and rewards still retained with your entity, then you are not in a position to derecognize such debtors. Okay, since you cannot derecognize, what you will do? You will increase the inflow in the asset side. You will increase the cash portion. Okay, this is asset and liability. Liability. You will increase the cash by the amount that you have received, and correspondingly what you will do, you will increase financial liability over here. Okay, so this will be a financing activity cash flow. Whether if it is non-recourse, this means that all the risk and rewards have been transferred. Since all risk and rewards have been transferred, what you can do is you can now derecognize such receivables, or you can say debtors. Okay, in this case what happens is here there is asset and liability. Since you can derecognize debtors, you will decrease those debtors and increase such cash. Okay, so there will be inflow, but as an operating activity. Okay, this is debtor collection, simple debtor collection. But earlier, since you were retaining all the risk and rewards, therefore it was financial liability. And on the time when you will be finally settling, okay, then if there is no cash inflow and outflow, then this will be cancelled out. The debtors and financial liability will be cancelled against each other. Okay, there will be no more debtors and no more financial liability. Next question. We have covered illustration number 5. Let's come to illustration number 6. Find out the cash from operation by direct method and indirect method from the following information. See, as you know, the direct method and indirect method, the answer will be same, okay, but the presentation is different. In direct method, you start with all the incomes, okay, cash incomes, and then minus all the cash expenses, and the remaining that you get is your net operating cash. Whereas if we talk about indirect, what you do, you start with P&L, okay, profit and loss, and then remove or you can say adjust the non-cash, non-operating incomes and expenses. Okay, do working capital adjustment, and then the answer that you get or the amount that you get will be considered as operating. Okay, see, now your sales are given. This is normal P&L statement. Okay, sales is 5 lakh, but this is accrual system, and for the cash flow system we have to reach out to a cash sales. Okay, so this might have cash and credit both, so you have to bifurcate on the basis of further information and see what is the cash sale. Okay, and that will be included in the cash flow statement. Now comes cost of goods sold. This is all accrual basis. Okay, these are recorded as and when done. They are not considered with what? With the actual cash impact. So you will be considering the purchases. okay, purchases, or you can say creditors. Okay, you will and the you will adjust this amount, what was the creditor position before and now, okay, and what you have purchased additional and what is not, okay, what was still remaining, and that's how you will get to a position where you will get to know the real outflow from your entity's pocket. Okay, now administration and selling overheads, this can be either cash or credit, you have to see what it is, okay, on the basis of further information. Depreciation is always non-cash, it will be removed as it is non-cash item. Interest paid, it must be financing or investing activity as per Ind AS 7, or you can say as per the carve out, there is no option now available as per Ind AS that you can classify such interest as operating activity or dividend as operating activity. Loss on sale of asset, this is investing activity, this is, I guess, financing activity. Okay, so these will be removed as it is, no doubt. Profit and then tax 30,000. Profit after tax is 53,000. So for indirect method you will start with 53,000. Okay, and for income for direct method you will be starting from sales, and you will before that make a working note and calculate the cash sales. Okay, for direct method you will start with cash sale, and here you will start with profit after tax or before tax, whatever. Okay, PAT, you can start with this. Let's see, or PAT or PBT. There is further information given in which balance sheet is given. Okay, so as you know, you have to do working capital adjustment as well. And so, for example, simply, there has been in 2001 it was 50,000 equity shares, for example, and now it is 60,000. That means 10,000 has been raised. 10,000 fund has been raised. Okay, so this is financing activity. So you have to carefully look. Property, plant and equipment. Earlier it was 65 and now it is 75. Investment 10,000 is increased to 12,000. Inventories 13,000 has been decreased to 12,000. Trade receivables was 7,000. Now it is 10,000. Cash and cash equivalents 5,000 and 6,000 respectively. Non-current liabilities 35 and now it has become 33. Trade payables 8,000 now have increased to 12,000. Payable for expenses is 7,000 to 10,000. See expenses, which expenses? What are the expenses above? Okay, it might be related to these expenses. Let's see. Okay, solution has come in. These expenses are more related to administration and selling overheads. Okay. Now what you need to do is, firstly you calculate from direct method. For this, calculate cash sale. For cash sale you have to adjust debtors. Okay. So previously, for example, if you are receiving any cash amount today, or you can say in this current financial year, this might be related to current sales or previous month sales or this particular financial year, or it might be related to, such cash inflow might be related to the previous trade receivables, okay, the debtors of previous year, it might be. So what you need to do, you need to adjust the opening and closing debtors in the sales amount, and then what you get is your cash sales. Okay, see note. First of all, sales 5 lakh, opening debtors will be added, and then closing trade receivables that still it is pending will be deducted, and the amount that you get is your cash receipts. So for direct method you will start with 4,97,000. How? After adjusting the debtor amount, after adjusting the opening and closing debtor amount. Do you get this very much right? Why we are adjusting debtors? Because for the sales portion, such 5 lakh sale might include credit and cash sale. To bifurcate that, you need to know what amount of cash you have received this year, and the cash that you have received this year might be related to current financial year and might be related to any previous figure. So you have to adjust the debtors opening and closing, and now what it is remaining, and the remaining portion will be considered as cash sale. Okay. Next, if we talk about cost of goods sold, you have to adjust your cost of goods sold, you have to adjust the purchase and the creditors, that means trade payables. Okay, you have to take out the cash purchases. So cost of goods sold, here you will also include the closing inventories less opening inventories. This is purchase, and then you will adjust the opening trade payables and closing trade payables. That's how you will receive payment to creditors, the final outflow from the entity. Okay, the final outflow of cash from the entity's pocket, how you will get after adjusting the inventories and the trade payables. Okay, so even if you do not are not very much sure about this pattern, what you can do is you can make a ledger for the same. Okay, if debtors are increasing, creditors are increasing, okay, the difference is always purchase and sale, so you can take out the purchase from this balance in figure. Okay, finally, if the purchase is this and debtors are this, creditors are this, okay, you can adjust this by making a ledger as well. It is as per your understanding, but if you are preparing for the ICA exam, please make sure that you strictly adhere to the pattern, to the presentation that the ICA module is providing you. Okay, strictly adhere. As much as you will be able to replicate the answer, the higher will be the chances of scoring. Okay, what you need to do, you just need to twice or thrice revise the answers and observe carefully the writing pattern, the presentation pattern of each and every answer. Okay, if you try to apply your own method, it might be right, but it will not help you in scoring ICA exams. Okay, and if you are professional, just understand this and skip this. Okay, next, in case of doubt, please ask. Okay, if we talk about third point is administration and selling overheads. It is 55,000. It might also have a bifurcation of cash and credit. What you will do, you will again adjust any payables or receivables that are present. Okay, as you know, the answer, the balance sheet has payables for expenses. Okay, so we have considered this administration and selling overhead expenses. It was opening 7,000 and 10,000. This will be added, 7,000 will be added, 10,000 will be deducted. The amount that you will receive will be your cash flow, final cash flow that has been outflow as an administration and selling expense. That will be adjusted in the cash flow statement. Okay. Okay, so overheads. Where is overhead? See, here it is overhead. Overheads, 7,000 has been added minus 10,000. Here comes 52,000, which is your payment for overheads. Now, if we come to direct method, you know cash sale. So, cash sale will be added minus cost of goods sold. Now, you know cash purchases. Cash purchases will be deducted. Then, as you know, the administration and selling portion, as you know, the cash 52,000 will be deducted. And then the depreciation. The other portion was, three parts were there. The depreciation, interest and loss, this all will be removed from the amount. Okay, from the amount, and then you will finally pay the taxes, and that's how you will reach to the profit after tax. Okay, finally what you need to do, 497 minus purchases. Okay, minus purchase, cash purchase, minus cash purchase, minus cash expenses. Okay, that's how, and minus taxes. You will get a cash flow after tax from operating activity. Okay, if we talk about indirect, you have to start with this and then adjust 1, 2, 3 and these figures. Let's see. And working capital adjustments are also needed. Okay, see, answer number 1 by direct method. Cash sale 497, cash purchases and overheads. Okay, other than this will not at all be included. See, if you are starting with profit before tax, you have to adjust this all. Since you are starting immediately with the cash incomes, since it is not included in such incomes and expenses, therefore you do not need to adjust it further. Finally tax, and this is your cash profit after tax. Now if you talk about indirect method, you have to start with the profit after tax, that is, or before tax, that is 83,000, or you can say after tax, that is 53,000. Okay, now depreciation, loss and interest, these three will be added back. Okay, and then working capital change will be done. What is working capital change? Your working capital change. Firstly comes as inventories. If we talk about balance sheet, liability side and asset side, what you need to do? Inventories. there was previously 13,000, now it is 12,000. There has been inventory decrease, inventory has been decreased. Okay, since you need to balance out the asset and liability side, okay, and you cannot move anything else, whole balance sheet is freeze, assume that, and you can only move or make changes in the cash amount. Okay, so for this investment, inventory has been declined. To balance this out, what you need to do, you need to increase cash. So therefore, whenever there is decrease in inventory, or you can say current asset, then there is always addition of cash flow. Okay, it will be rupees 1,000. Similarly goes for trade payables. Since it is 7,000 and now it has increased to 10,000, then trade receivables have been increased in the asset side. To balance out, what you need to do, you need to decrease the cash. Okay, let's see the answer. Increase in inventory. Okay, so 1,000 will be added. This is where you can try out your answer. Okay, finally after doing this, you will get net cash generated from operating activity. The answer will be same from both the methods. Okay, please, if you are preparing for our ICA exam and you really intend to pass it, please practice these questions on your own. Instead of referring some other material, please revise as much as number of times as you can the ICA module material. Okay, the study mat. We have discussed this example in our previous class, so I am skipping this. Next, illustration number 7. A firm invests in a 5-year bond of another company with a face value of 10 lakh by paying rupees 5 lakh. Okay, they have paid, there has been outflow of rupees 5 lakh. The effective rate is 15%. The firm recognizes proportionate interest income in its income statement throughout the period of bond. Okay, you have invested 5 lakh rupees and at the end of 5 years you will be receiving 10 lakh rupees. But it is a process that a company follows, a transaction treatment, that the 5 lakh interest income will be recorded in the books of accounts every year. Okay, in the 5 years. So 1 lakh, 1 lakh, 1 lakh, 1 lakh will be recorded in the books of accounts in the income and expense statement. Whereas now for the cash flow statement, has there been any cash inflow of such amount? No. Only it will be at the end of 5 years. Okay, so those 5 years in which the income and expense statement has been affected with such interest income, you do not need to include it in the cash flow statement. If it has been already included and if you are preparing as per the indirect method, okay, then you need to remove it, noting down as or commenting as non-cash item. Okay, now the firm recognizes proportionate income, interest income. Based on the above information, answer the following question. Firstly, how the interest income will be treated in cash flow statement during the period of bond. Okay, so it is, since there is no cash flow, so interest income will not be included during the period of bond. It will not at all be included. There is no cash flow. On maturity, whether the receipt of 10 lakh should be split between interest income and receipt from investment activity. Okay, so this interest income is your income from investment activity that you have invested of rupees 5 lakh. Okay, that was an outflow in the first year, and now at the end of 5 years the amount that you are receiving 10 lakh rupees. Such 10 lakh rupees should be bifurcated, okay, and should be separately recorded but under the investing activity itself. Okay, so on maturity, receipt of 10 lakh will be classified as investing activity with a bifurcation. You have to bifurcate and see that 5 lakh is the amount that I invested, has been redeemed, has been returned, and the another 5 lakh that I am getting on the maturity is the interest amount that I have earned on such investment. Okay, so this is an investing activity, but you need to bifurcate it and provide it in the two lines, okay, while preparing the cash flow statement. Initially only 5 lakh will be recorded and no income on the accrual basis will have any impact on the cash flow statement. Taxes on income, as you know, it is normally operating activity part, but if it is directly related to financing or investing, it will be included under financing or investing activity respectively. Okay, and ownership I have told you. See, illustration number 9. X Limited acquires fixed asset of rupees 10 lakh from Y Limited by accepting the liabilities of rupees 8 lakh. Okay, they have accepted 8 lakhs liability. Okay, and balance amount has been paid in cash, that is rupees 2 lakh. The cash outflow is only 2 lakh. The cash outflow is only 2 lakh and rest 8 lakh is the liability portion. Okay, how X Limited will treat all those items in cash flow statement? Since cash flow statement, such asset and liability will not be recorded, only the outflow of 2 lakh will be recorded under the investing activity head. Read this. Okay, because the asset has come in and the liability has come in. Okay, but there has not been any change in the cash flow except rupees 2 lakh outflow. Read this answer, read this solution. Let me know in case of doubt. If you want to see the whole course, okay, or if you want to access the whole course, you can check out the description box. And other than that, this is the pattern that we follow throughout. Okay, we study the concepts, we study the basic that the standard provides. Okay, and then in the later class we discuss all the question answers of the ICA module thoroughly. Okay, this is the pattern that we follow. Illustration number 9 we have completed. I hope there is no doubt. Let's see the illustration number 10. An entity has bank balance in the foreign currency aggregating to USD 100, okay, US dollar 100, equivalent to rupees 4,500. At the beginning of the year, the opening balance is, this is the opening balance, rupees 4,500, that is equivalent to 100 US dollars. Presuming no other transaction has taken place, the entity reported a profit before tax of rupees 100 on account of exchange gain on bank balance. Okay, see, exchange gains, if it has been realized or if it has impacted any cash, then only it will be reflected in the cash flow statement. If it is just unrealized gain or it is not impacting any cash inflow or outflow, then it will not be considered as per cash flow statement. If it has been included in P&L itself, okay, as per the profits, then you need to remove it or adjust it by under the head non-cash item. Okay, so there has been a profit of rupees 100 on account of exchange gain on the bank balance in foreign currency at the end of the year. What would be the closing cash and cash equivalent as per the balance sheet? First rule, the 100 profit, the rupees 100 profit, and no other transaction has been taken. Okay, so, and this 100 profit is what? This is P&L, and this 100 profit is non-cash. So you will have to remove such rupees 100. Okay, so such profit will be 0. Operating profit will be 0, nil. Now, it is a rule that whenever you are calculating the cash and cash equivalents, the amount, the adjusted amount, the foreign currency exchange gain loss have to be included while calculating the cash and cash equivalent. So this 100 rupees will be included in the cash and cash equivalent. So earlier it was, opening was 4,500. This will be added with rupees 100. Okay, the exchange gain loss, and then the closing will become 4,600. Okay, this is a rule in as per the Ind AS 7. Okay, if it impacts cash flow statement, then it will be included in the cash flow. Other than that, for just presenting part or reconciliation part, it will be included, the exchange gain loss will be included in the cash and cash equivalent portion. See the solution once. See, this is a star point that I've added on my own. You can write it somewhere or noted down. The effect of exchange rate changes on CCA held or due in the foreign currency is reported in the statement of cash flow in order to reconcile the cash and cash equivalents at the beginning and at the end. Okay, they need to be reported under CCE, cash and cash equivalent. Next, illustration number 11. Non-current following is the balance sheet of Kuber Limited for the year ended 31st March 2022. 2001 and 2 figures are given. Non-current asset, property, plant and equipment, 12,500, 13,000. Intangible asset, 30 and 50. Other financial assets, 170 and 145. Deferred tax asset, it has been net. Other non-current asset, 770, 800. Financial assets, investment and cash equivalent, other current asset, 85 and 195. Okay, these are opening figures and the current one is the closing figures. Equity, other equity has been increased. Non-current liability, financial liability, long-term borrowings, 5,000 have been declined to 2,000. Other non-current liabilities, financial liabilities, trade payables, bank overdraft, other current liabilities. Now, the profit after tax for the year ended is 4450. Okay, profit after tax is 4,450 rupees, 450 lakh rupees. Interim dividend has been paid, so this is financing activity, no doubt, 450. Depreciation and amortization charge in the statement of P&L that has already been charged. This is non-cash, you need to reverse it. What are this? For property, plant and equipment, it is 500 lakh, and for intangible asset, it is 20 lakh. This is depreciation, non-cash item. Okay, it has already been included in P&L. During the year ended March 31st, 2002, two machineries were sold for 70 lakh. Two machineries were sold for rupees 70 lakh. So 70 lakh has been inflow. The carrying amount of these machines on March 31st, 2002 is 60 lakh. Carrying amount is 60 lakh. You will deduct the depreciation and all if it is given separately. Okay, and then finally the inflow that you are getting. Okay, and if there is any gain loss and it has already been included in P&L, then you will be reversing it. Income tax paid during the year is 105. So you have profit after tax. To make it profit before tax, you can remove such taxes. Okay, 105. You can add back such taxes. Other non-current or current assets and liabilities are related to operations of Kuber Limited and do not contain any element of financing or investing activity. So remaining elements are to be included as per the operating. You do not need to make any changes. Using the above information of Kuber Limited, construct a statement of cash flow. This means you have to make indirect method. You have to make whole cash flow statement. Okay, right now. So you by indirect method, you will start with the profit. You will start with the profit after tax or before tax. Okay, so profit after tax is given, that is 4450. You will add back the tax and you will make it profit before tax, that is 4450 plus the tax is 105, and later in the later portion you will deduct such portion. Okay, and then see. Okay, 445, this is no doubt, I guess this is PBT, profit before tax. Then the depreciation and gain on sale of machine. Okay, the depreciation is 520. This is okay. This is given in the question itself. See, how do you need to do this for making sure that there is no error while you are making the cash flow statement? Go one by one. Go one by one. Okay, and mark over here that I've done this. Okay. See, profit after tax we have taken. Interim is waiting because we will take this in the financing part. So if you are okay with this, what you can do is you can make operating head and then leave a little space of like for approximately 10 lines, and what you can do, you can start financing activity. Under the financing activity head, you can simultaneously put the figure of interim dividends paid. Okay, and you have to make sure that this has been outflow from the cash as well. Okay, next, property, plant and equipment depreciation we have put in. Okay, next, during the year to the two machineries were sold. Okay, so you are receiving 70 lakh. So also after leaving 4-5 lines under financing activity, you can write the investing activity portion, okay, head, and then you can write the income that you are getting, the inflow that you are getting from selling the two machines under investing head. Okay. Now the gain on sale of machine, that is 70 minus 60, has already been included in the P&L. But you need to remove it. This is non-operating, and therefore you have removed from your non-operating item. Okay. Increased in deferred tax asset. Okay, we'll come to this later. Part. Okay. Changes in operating, you can do this, current liabilities and incomes. Okay. Working capital changes, you can adjust this on your own. Now income tax, you know, cash flow from operating activities you have got. Now investing activity, as you know, sale of machinery you have got 70. This is, we will for this you have to refer balance sheet. Okay. See, for if we talk about one by one, if we talk about, see, we'll start from here. Then property, plant and equipment you have already sorted out. Okay, so there is 12,500 opening figure. So you make a ledger of it, PPE, make a ledger of it. The opening figure is 12,500, the closing figure is 13,000. There has been depreciation of 500. Okay, then the balancing figure is what? Okay, the purchase or sale item, and the selling item is 60 lakh has been removed. Okay, so you have to make a ledger of the same. For intangible assets as well, so 30 is the opening, closing is 50, and you have put 20 as your depreciation. Okay, so you can make a ledger of IA. Making a ledger makes number of errors very less. Okay, chances of errors very less. So you know how to make it. If there is a debit balance, you write it over here, debit. Okay, and your credit and debit. Okay, and this is how you will make a ledger. For intangible asset as well, the opening figure is 30 and the closing figure is 50, and the depreciation is 20. Okay, so the remaining part will be adjusted. Okay, either it will be increase or decrease, and whatever the increase decrease will be an investing activity. Okay. See, investing activity. See, if we talk about this, okay, if we talk about intangible asset, see, I can show you intangible asset. Okay, so debit balance and credit balance. Opening is 30, opening figure, and closing balance is 50. There has been depreciation. Of 20. Okay, so deb part is 20. Now what you need to do, 70, here the balance in figure is 40. So this is the amount. Now if it is debit means there has been addition means purchase. Okay, so if there is purchase, there has been outflow of cash, and therefore this 40 has been deducted. This is how the ledger works. Your 70 and 70 becomes total. Are you alright? Are you getting this? In case of doubt, please ask me. Okay, make sure you make a ledger throughout simultaneously. This will help you a lot. Now if we talk about next, this was PPE, and then we talked about other financial asset. Now comes deferred tax asset. This is 750 and 855. The difference will be treated over there. Other non-current asset 770 and 800, unless any other information has been given. Is there any other information? No, only taxes have been given. Okay, so here you can see DT, deferred tax asset. Okay, 750 was opening and 855 is closing. There is no further increase or decrease, and then this will be included as per operating part. Are you getting this? Try it on your own. Okay, only see the question and try to attempt it on your own. there will be mistakes. Doing mistakes in practice is great, okay, because you know that where you are getting stuck, where is the silly mistake that you are getting done. You can improve it. But if you do not attempt it over here right now and then finally sit for the exams, and you might get stuck, okay, what is it? Because just by seeing is some other experience, and practicing on your own by writing it gives you another level of confidence, okay, and makes you prepared for tackling the questions in exam. Okay, let's head towards the illustration 12. Try this illustration number 12 on your own. This is similar, quite similar. Okay, I can tell you the main thing that is different in this is that they are acquiring a portion. Okay, so you have non-current assets and current assets of A Limited. Okay, now this is consolidated. Okay, this is consolidated means if there has been any purchase or sale of any entity, then it has been already combined in such values. Okay, if the entity has bought in, acquired or sold out any portion of the entity, then it has been included in such portion. Okay, in this balance sheet, it is consolidated one. Now, extract of the P&L is also given. Revenue, cost of goods sold, gross profit, other income, operating expenses, other expenses, interest expense, share of profit of associate. Okay, profit before tax. Let's see what is this. A Limited has spent rupees 30 lakh on renovation of building. A Limited charged the entire renovation cost to profit and loss account. This renovation is a part of investing activity. Therefore, this 30 lakh should be removed and should be added to investing activity. On 1st April 2001, A Limited acquired 100% shares. So, acquiring 100% shares is investing activity as there has been change in control for rupees 300 lakh. Fair value of the asset acquired and liabilities assumed under the acquisition are as under. Okay, so the amount that they have received, the assets and liabilities received are from S Limited are PPE 140, inventory 60, trade receivables 30, and cash and cash equivalent is 20 lakh. So they have received 20 lakh. They have paid 30 lakh. 30 lakh has been spent on renovation. Okay, and 300 lakh cash has been given. So they have given 300 and they have received 20. Okay, total asset is 250 less trade payables that you have gotten from S Limited is 50 lakh. Net asset on acquisition is 200 lakh. They have paid 300, they have received 200 lakh worth assets and liabilities. A Limited's property and plant comprise the following. Carrying amount on 1st April is 4650. Addition at cost including assets in S Limited is 800. Revaluation surplus is non-cash. Disposal of asset is investing. Depreciation for the year is non-cash. So the carrying amount is 4750. A Limited constructed a machine that is qualifying asset and incurred its construction cost of rupees 40 lakh that has been charged to other expenses of the interest cost of rupees 110 lakh charged to P&L. 10 lakh includes interest cost on specific borrowings. Okay, there has been interest cost of 110. This interest cost is what? Financing. And this 10 lakh interest cost have been on specific borrowing. If there is specific borrowing which needs to be capitalized, what you need to do? This will be transferred to such specific asset. Okay, added to asset value. As added to asset value, not to PL. And if it already included in PL, you will remove from PL. See, any expense that you are doing will be having a debit balance. Okay, there can be two treatments. Either it will be debited to expense, okay, in PL, or what you can do is you can add in the asset side. Okay, so if you are talking about that such particular 10 lakh interest should be added to the asset side, should be debited in the asset itself. Okay, then you need to reverse it from the P&L. There has been construction cost of 40 lakh. Okay, this is what? This is investing activity. So the first 40 lakh will be taken moved towards investing activity. Property, plant and equipment was sold for 630 lakh. Gain on disposal is adjusted against operating activities expenses. A Limited purchased 30% interest in associate for cash on 1st April 2001. Associate reported profit after tax of 400 lakhs and paid a dividend of 100 lakhs for the year. Okay, they have paid a dividend, they have a profit of 400 lakhs. Impairment test was conducted on 31st March 2002. The following were impaired as goodwill impairment was 265, intangible asset impairment loss was 600 lakh. The goodwill impairment relates to 100% subsidiaries. Assume that interest cost is all paid in cash. Okay, all paid in cash. Goodwill impairment relates to 100% subsidiary. You are required to determine cash generated from operations from group reporting purposes for the ended 31st March 2002. Okay, you need to make a cash flow statement and recognize that what should be the CC amount. Okay, we'll head towards the working note first. Profit, okay, it is 1840. Renovation cost 30 lakh has been added back. Why? Because it is not a part of P&L. Construction cost 40 and 10. This has been done. Okay. Reverse. Then the amount that you receive is profit before tax. This is all cash. This is all cash. Why cash? Because the non-cash items and the investing activity items have been removed. Now, changes in trade receivables, opening, closing, you can do it, inventory and trade receivables. Now, if we talk about cash flow statement, profit before tax is 1920. How come? By calculating 1920 this. Okay, revised profit before tax. Now, profit on sale of PPE has to be deducted. Why? Because as you know that property, plant and equipment was sold for 630 lakh. Gain on disposal is adjusted in operating expenses. Since this is non-operating, you need to adjust it from P&L. Okay. Now next. Depreciation will be added back, no issue. Impairment, these are all non-cash. This is non-operating. Okay, this interest expense should be added into liability part. Okay, interest expense 110 minus 10. This is what operating. This is what operating. And what about this 10? This 10 lakh has already been taken up. Okay, so since this PBT, profit after tax or before tax, whatever, okay, was earlier having 1110 deducted as expense, but now as you know this 1110 has two part. 100 lakh should go in financing part. Okay, financing, and this 10 lakh should be capitalized or should be added into the asset portion. So this whole 1,10,000 should be removed. Why we have deducted only 100? Because this 10 lakh that must be capitalized have been already removed in this 1920, have already been adjusted. As you know, in the working note we have already adjusted this 10. Okay. Next, share of profit. This is also other activity, not operating activity. Share of profit of associate, this will also be removed. Now working capital changes have been done, and this is how cash generated from operating activity has been calculated. Okay, I hope you understood this. These big questions are easier to look. Okay, but while you practice on a paper and on your own, okay, by only seeing the question, you will get to know if you are able to attempt or not. There will arise many doubts, what to attempt, how to attempt. I can just tell you how to do it. Okay, first read whole question nicely, carefully, and then mark it that what is related to what. okay, which should be included, what each and every extra additional information is indicating. Mark that in that balance sheet and P&L portion. Then by that P&L and balance sheet, go one by one and see what changes need to be attempted. What you can do is, to make it right every time, error free, what you can do is, you can simultaneously prepare operating activity, investing and financing head, okay, and not wait that I will do it afterwards, because it might get skipped, okay. You cannot remember each and everything, okay. So what you can do is, read out each and every additional information and give its impact hand in hand. Okay, next is test your knowledge. You can try these question answers on your own, this first one, okay. Even I can ask, if you have any doubt, I can make you understand. Ask. Firstly, from the following summary cash account of XYZ Limited, prepare cash flow statement for the year ended March 31st, 2001 in accordance with Ind AS 7 using direct method, okay. So you have to make direct method cash flow statement. Firstly, balance on 1st April 2020, okay, nothing. Issue of equity shares is financing activity. Receipt from customers is operating activity. Sale of fixed asset is investing activity. Payment to creditors is operating activity. Purchase of fixed asset is investing activity. Overhead expenses, operating. Payroll, operating. Tax payment, operating. Dividend has been paid. Dividend payment is what? Okay, dividend paid as it is outflow. This is financing activity. Repayment of bank loan, financing activity, okay, and the closing balance. So operating, club all operating and financing and investing individually, and then final match it with the closing cash flow. See, we can see the answer once. Question number 2, page number 2.144. 2.144. See, okay, you are just clubbing these all, okay, as we have seen, investing, operating and financing, okay, and finally you get it, balance it with opening, and finally you get the closing amount. This is really very easy question. 41. Let's head towards third question. Z Limited has no foreign currency cash flow for the year 2001. It holds some deposits in a bank in the USA. The balance as on 31st 12 2001 and 31st 12 2002 were $1 lakh and $1 lakh 2000. Okay, so there has been increase of rupees $2000. Okay, the exchange rate on 31st December 2001 was 45, and the same 31st 12 2002 has been increased to 50. So there has been 5 rupees increase as well. Okay, so this 5 rupee is exchange gain loss, okay, exchange gain or loss, whereas this 2000 rupees is itself an increment in the asset. It was, thus the deposit was reported at 45 lakh in the balance sheet on 31st. Opening figure was 45 lakh and it was reported at 51 lakh in the balance sheet on 31st 12 2002. What these transactions should be present in cash flow statement. Okay, so this 5 lakh is your operating activity. Okay, this 5 lakh nahi, this $2000 that have been increased is your profit in your operating activity. So this $2000 should be included in your operating activity, whereas this 5 rupees increase per dollar is your exchange gain loss, which should be represented in CCE portion. Question number 3. The profit and loss account was credited by $1 lakh, that is 2000 into rupees 50 towards interest income. Okay, so this is interest income interest is $2,000, profit, okay, this is your profit. It was credited by exchange difference, that is 55 rupees, and exchange difference was rupees 5, okay, rupees 5, 50 minus 40, that is 5 lakh rupees, okay. So 1 lakh here and 5 lakh here. From the net profit before taxes. However, in order to reconcile the opening balance of cash and cash equivalent, you have to show this exchange difference of rupees 5 lakh, okay, in this CCE portion. In the notes to cash flow statement, cash flow arising from transaction in foreign currency should be recorded in ZS Limited for functional currency by applying to the foreign currency amount the exchange rate between the functional currency and the foreign currency at the date of the cash flow. See, this amount, if you are including it as an interest, then it will be financing activity. If you are considering it as a profit, okay, then it will be considered as your operating activity, okay. So in your answer it is considered as an interest portion. The increase of rupees 2,000, that is from 1 lakh to $1,02,000, this $2,000 increase has been considered as interest amount, and therefore it will be considered as investing activity, financing activity, okay. You will not take it to operating activity. If you are considering it as a profit due to any other reason other than interest and dividend and all, then you can charge it to under operating head. Next, fourth question. Company A acquires, this is very good question, 70% of the equity stake in company B on July 20, 2001. The consideration paid for this transaction is as below: 15 lakh cash, okay, cash outflow has been 15 lakh, 2 lakh equity shares have been having face value of 10 and fair value of 15 per share. On the date of acquisition, company B has cash and cash equivalent balance of 250 in its books of account. On October, okay, so now this 15 lakh is your cash outflow, and since you are acquiring control, there has been change in control, it will be investing activity. It will be investing activity as you are acquiring control. On October 10, 2002, company A further acquires 10%. So earlier you were having 70% and now you are having 80%. There has been increase in your share, okay, but is there any change in control? No. Since there is no change in control, then this is your financing activity, okay. Advise how the above transaction will be disclosed, presented in the statement of cash flow as per the Ind AS 7. So this 8 lakh portion, okay, again that you are buying, the second purchase will be included in financing portion. When you are doing the first transaction, you are acquiring the control for the first time, then it will be your investing head. See, question number 4. As per para 39 in Ind 7, the aggregate cash flow arising from the obtaining control is always, or losing control is investing activity, okay. We'll head towards the conclusion. See, read this answer on your own. Read it. It is all that I have told you right now, okay. Before that also, while discussing the notes, we have discussed this. Little tricky question on the conceptual clarity. If you have it, then there is no doubt over here. When to classify investing, when to classify financing, I think it must be clear after reading the notes and attending the class, okay. Last 2 questions are there. These are practice questions and repetitive questions, okay, but you need to try it. Let's head towards next question. Question number 5. Okay. This is a practical question. You need to attempt it on your own, practice on your own, okay. In case of doubt, you can ask me. Question number 6, we'll head towards question number 6. During the financial year 2019 and 20, ACCA Limited have paid various taxes and reproduce the below mentioned records for your perusal. First, capital gain tax of rupees 20 crore on sale of office premises at a sale consideration of rupees 100 crore. Okay, so there has been profit, capital gain tax has been 20 crore and the sale consideration has been 100 crore. This full is investing activity. As you know, if the tax is particularly related to any investing or financing activity, then it will be charged under such investing activity. Okay, so 20 crore tax as well as the 100 crore income will be your investing activity. 100 crore will be your inflow, whereas 20 crore, that is your tax outflow, will be outflow, but both will be considered under investing activity. Next, this means you have to, under investing activity, you have to add 100 crore and deduct 20 crore. Income tax of rupees 3 crore on business profits amounting rupees 30 crore, and assume entire business profit as cash profit. This 3 crore profit will be your operating, no doubt. Dividend distribution tax of rupees 2 crore on payment of dividend amounting to 20 crore to its shareholder. So there has been outflow, dividend has been given out, okay, so minus 20 crore and 2 crore tax, minus 2 crore, okay, under financing activity. Income tax refund of rupees 1.5 crore, refund of taxes paid earlier periods for business profits. This is entirely your addition to operating activity. Okay, addition to operating activity. Last, again, 7th one is practical question. Please try it on your own. The concept remains same. There are 2 methods. Go through it, practice on your own. Okay, in case of doubt, please ask me. And if you are appearing for any exam, surely do practice in your rough copy, final copy, fair copy, anywhere. Okay, and do mark. If you are doing any sort of mistake, then please mark it on your module itself, because at the time when you will be preparing for final exam, okay, revising for that, you will not be having time to write down these all questions on your hand, by your hand. Okay, so for that quick revisions, you just need to revise all the silly mistakes, all the places where you get stuck. Okay, if you revise through them, it will be a very help for you to revise all the questions quickly, in a quick manner, and you will not be leaving any sort of main quick critical points. Okay, see you in the next video. Till then, take care, be safe, stay tuned for full course, and for any query, please download the app and reach out to us. Okay, happy learning, all the best.